is a video that seeks to lay out one possible method of diversifying an investment portfolio. I'll begin saying I am not a financial professional. I am not a licensed financial advisor. I do not proclaim to have any amazing secrets about how to purchase stocks or securities, equities. But I am a person who tries to manage my money to a plan, and the plan is laid out in the spreadsheet. And so we're going to try and go over the spreadsheet, explain how we got to this point, what the methodologies are, and hopefully it'll help somebody out. So without further ado, you should know all the numbers you're seeing are fictitious. These are real securities. In column B, these are actual ETFs, mutual funds, what have you. But the 401k IRA, Roth IRA, the number of shares, which is represented in purple, those are all fictitious. Those are not my actual holdings. The column F, the price of the underlying equity, this is true. Google in Google Sheets gives us a nice function, Google Finance. We can call a particular ticker symbol. In this case, we refer to column B, and then it goes out and grabs the price. At the very bottom, you can see Google themselves saying quotes are not sourced from all markets, may be delayed up to 20 minutes. So this is by no means a method for high frequency trading or day traders or any of that stuff. This is for people who understand basically that they probably should diversify and they should probably be in ETFs and mutual funds, but they don't really know how to get started, which ones to pick, et cetera, et cetera. So without further ado, basic explanation, the name of the ETF or mutual fund, column A down here, starting from row 33, we have income investments. Those are typically bond funds, funds that simply hold different bonds from municipalities, the federal government, corporations that do bond offers, things like that. And then, of course, the ticker symbol, column B. And I've divided up 401k, IRA, and Roth IRA as three different retirement vehicles, right? They have different rules. That's sort of beyond the scope of this video. And then in purple again, this is the number of shares that you have in each of these securities, right? So you can have fractional shares. And for this example, we just have whole shares of everything, but it is certainly possible to have fractional shares, which is why we have 3 decimal places after the period here. Everything else we sort of leave alone, but the goal is to make sure that we target a particular distribution of our dollars across all of the different sectors and across large, mid, small, and of course domestic and foreign. So we have a total, if we scroll down, of $401,000, $695 amongst all of our investments. And we want to make sure that we're maintaining a target distribution, like I said. So along the bottom row here, we have 5 sheets. Funds is the first one we're going to click into. This sheet seeks to pull information from Morningstar in this case, and all we're doing is gathering the statistics that Morningstar gives freely to all of the investors that use their website. You do not have to be a premium member to get this information. You just need to maintain the information over time. I've written a script that updates it, and we have all the attributes of a particular security, in this case EWX. You can see that they are heavily weighted in foreign stock. So this is categorized as emerging markets, small cap funds. So you get emerge SM in row 2. And that means they are heavily concentrated in small companies that are in growth countries. So, markets like China, South America, like Brazil, obviously markets in Africa are starting to, really come to life in the past few years. And of course, the next 10, 20, 30 years, who knows, a lot of the growth in the world economy may come from those types of places. We all know that China's been booming for a long time, but there's certainly many, many countries that haven't, fully hit their final form, as it were, and are emerging. So that's why we have that emerging thing. But if you contrast that to EZM next to it, this is mid-cap concentration, and it's a blend between value and growth. They are 99.37% invested in those types of companies in the U.S. market. And so this is one way we look for a distribution in our money. We want to make sure that all of our dollars are not concentrated abroad, nor are all of our dollars concentrated domestically. But you, of course, need to decide your individual risk tolerance. How much do you want to expose to emerging markets versus domestic markets? I can't begin to make that determination for you. What we can do, though, is track. Now we have Morningstar saying giant corporations, large, mid, small, and micro, and it shows you the percentage breakdown amongst these 5 attributes, we'll say, of the funds that EWX is managing. And the same with EZM and so on across the board. Then you have sector weightings, right? And these are Morningstar sectors, basic materials, consumer cyclical, et cetera. Your cyclical, sensitive, and defensive are the 3 primary sector categories inside the sector weightings of Morningstar. And so all of this information just comes from Morningstar, right? Nothing has been made up here. And we just update these as the underlying securities themselves, the equities themselves, are updating their own distribution, their own investments. These numbers will change over time, but typically not daily, certainly. Typically weekly, monthly. You might see some change across the board. Some won't change for a long time. Could be months, could be years. Then we want to go to our calculations. Now this tab gets a little bit crazy, but there's only a couple things to call out. First of all, these formulas have already been laid out. We're going to look up from our funds sheet wherever we see EWX, and we're going to pull in the percentage of that fund's investments that are held in cash, in stocks, U.S. stocks, foreign stocks, then bonds and other. And we're going to multiply that by what we have in dollars, like actually invested, right, in that particular fund. So we have 42.7550 invested total in that particular fund, right, according to these calculations. And due to some crazy kind of rounding and things like that, it is possible these numbers are slightly off of actuals, but it's too deep to really bother with the why. Just know that over here in column V, we're summing up row 7. So we're trying to say, what are all the dollars we have? Are they all basically accounted for, right? And we want to make sure that this number stays pretty close to what we're going to see back on the holdings page. Then you can see the breakdown in terms of the sectors themselves. So basic materials, consumer cyclical, et cetera, et cetera. These are the actual dollar amounts that we have exposed to that sector based on our investment in this particular fund, okay? So this is, you see that the subtotal here doesn't match precisely with the subtotal in row 7, right? And again, there's some trickery in the math, but it's okay because we're using it as a guide, not some absolute truth on how many pennies are invested in each particular fund. So then we go back to our allocation tab, and essentially the entire spreadsheet is based on making sure this screen is your guide. Okay, you are looking for a total breakdown by sector to match your target. And so the target comes from, again, this weighting, like F13, right, which is the column way down here, 95%. This is a target of equities that we want to hold, right, versus income. So you see that on row 2. If you're age 32, it's recommending to be risky, take risks, right? You've got many years ahead of you in the workforce. There's no reason that you should be invested fully in only income generating stocks. You want to go for growth. And that's the traditional thinking. Certainly, again, not a professional, do what you want. But the purpose of this spreadsheet says, hey, 95% of your money should basically be in equities that are going to grow and show your return, and 5% of your money should be in bonds, more conservative CDs, even high yield savings accounts if you want, just kind of really, really safe things that focus more on the interest rate, dividends, things like that, rather than the ability for that security, that equity to grow due to the company being wildly successful. So that's where we get this number, 95%. And then it tells us that our target is 20.25% of 95%, or 19.24%. We want to make sure that 19.24% of our money in this example is invested in the healthcare sector industry. And what we have currently is a total of $44,000, which represents almost 11% of our total money in healthcare. So we are deviating from our target by 8.283%, or $33,000. And that's really where this diversification spreadsheet, this is kind of the answer, right? Essentially, we're saying, hey, you've got $49,000, almost $50,000 in excess invested in the technology industry, right? And that's not just in one fund, that's sort of across the board as an aggregate. You are underinvested in healthcare by $33,000. So it should become pretty obvious that in order to stick to our plan and not deviate from our targets that we set for ourselves, we need to sell tech-heavy ETFs. Maybe we have some ETFs that are only tracking the technology sector. If so, it's very easy. We can sell a number of shares out of that fund and use the proceeds to put them into healthcare, or we see some other negatives, right? We see negatives in industrials, infrastructure. That's the next big category. And then other things sort of drop. This one's in the 7,000 range, but everything else is kind of under 5,000. And again, you'll see fluctuations as the price of these ETFs, mutual funds, whatever, change. Therefore, we shouldn't be rebalancing daily, right? But when you hear people talk about rebalancing their portfolio, and some people say, I do it monthly, I do it quarterly, semi-annually, annually, whatever, this is sort of what they're talking about. They're talking about making sure that they get their money lined up with their plan. And, as the stock market moves and does its thing, some sectors are going to be wildly successful. They're going to outpace other sectors. Technology has been that category that over the past, certainly 10 years, but before that, probably the last 25 years, it's just been an enormously successful category for companies that are offering technology products, software companies, hardware vendors, et cetera, et cetera. I mean, we all know Google and Facebook and Amazon and things like that. These companies didn't exist, 40 years ago, for sure. And so it's just taken the world by storm how popular this has been. But we also know that we have an aging population of baby boomers in the United States, and we know that they're retiring. That news is not secret. And we know that as people get older, typically the demands, on their own physical health become great. People, body breaks down. People are going to get sick. People are going to need healthcare services. So, my personal prediction is over the next 10, 20 years, we're going to see a whole lot of healthcare focused companies do very well financially. Hopefully they're fixing what's wrong with us. They're curing amazing things like cancer. That would be amazing. And whatever company comes out with solutions to these problems that are affecting people en masse, they're going to be very successful financially. So, I don't know who's going to win and who's going to lose, but I feel safe saying that the healthcare should represent roughly 20% of my portfolio, because I think that over the next 10 or 20 years, you're going to see a lot of money spent in that category. So that's basically what this spreadsheet is designed to tell you, is what to sell out of and what to buy into. Once you have those dollar amounts, you can go back to the funds page if you want. You can look for companies that have a huge weighting, say in healthcare. Like right away, we see PRHSX, 98% of its dollars are in healthcare companies. So this would be a classic one to buy straight into. Not saying that that's necessarily what I would do. You have to look deeper than just the numbers, but it certainly helps you identify very quickly which of the funds or ETFs that you're already holding, assuming you bought those because you believe in those funds and their managers and whatnot, you would be safe buying into or selling out of, because it represents the sort of percentage weightings that you're looking for. So that's kind of my explanation. I hope it was not too crazy and all over the board. It does assume certain familiarity with the stock market already, but hopefully you can use this. I'm going to link to this spreadsheet. Again, these are fictitious numbers. I don't necessarily hold all these funds, and I certainly this is not my 401k, IRA, or Roth, but I did want to demonstrate how the spreadsheet was designed. And you can certainly take it and do what you will with it. Just trying to help other people who want to get a better handle on their money. Maybe have one tool at their disposal that can hopefully point them in the right direction. So if you found this video useful, it would really make me feel good to see a like or something. I'm not a YouTuber. You don't have to subscribe or whatever, but just let me know that it helped you out and it was worth me taking the time to make this. So thanks and good luck.